You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? This is Mike from The Moose on the Loose. How are you doing on this Tuesday? I mean, it is bright and sunny here. It feels like summer's already here, even if we're in the middle of spring, so I cannot complain. The pool's almost ready, full of chemicals, but at least it's blue, right? All right, today I want to answer this big question. Should you invest in GICs, or Certificate of Deposits? So the idea here is, well, there are many GICs offering a 4-5% yield. If you dig some enough, you can get a pretty solid rate. Even better, it beats the inflation. So as we expect that inflation is going to slow down, maybe like over around 3% for a while, or like the goal for Bank of Canada and also from the Fed is to drop it down to 2. We don't know when it's going to happen, but in any cases, at 4 or 5% yield, the GIC is fully secured. You can do like a bond ladder, like a GIC ladder for like 1 to 3 years or 1 to 5 years. So you have like liquidity all the time. So it seems a pretty good deal. And I get it. And I was kind of like surprised, but a lot of investors around Twitter, around my YouTube channel just told me at the end of 2022, around October and November, is like, Mike, why, especially like if we go back in 2022, 22 was a really bad year on the market. I was down roughly like 12% by the end of it. And then I got that thought from a lot of investors, like, why would you bother getting down 12% on your portfolio when you can invest fully secured at 5%? And I'm like, yeah, when you isolate that argument for a very short period of time, you look like a fool. If you invest in the stock market, you're down double digit, while you could have like a safe 5%, no worries, and then move on, right? So here's a funny thought though. I just looked for fun and imagine that in November of 2022, I would start investing. So I had like the choice between investing in the stock market or in a GIC. So the GIC would have given me roughly like 5%, maybe slightly higher than that at that point. And, or just buy like, would just go with the classic today. So just buy XIU or SPY. So a US and a Canadian ETF tracking the TSX 60 and tracking the S&P 500. So nothing too fancy. Nothing complicated, very like super basic. Let's go 50% on the market, Canadian, US, or invest in a GIC. So as of today, kind of ironic, but if you have invested in a GIC, you made 5% in 23, you're on your way to make another 5% this year. So by the end of 24, you would be up 10%. I would have already been up if I invested in the XIU by almost 20%, so 19.47. That includes the dividend payments as well from the ETF. So up 20% on the Canadian market, and you probably saw it coming, up 41% with the US market. So for an average, if you're going like half and half, you would be like a roughly around 30% up right now. While with the GIC, you would be on your way to make a 10% increase of your capital, or just like 10% gain. So even though you thought, well, that was an amazing deal, well, now if I tell you, if you have the choice to make 30% over 2 years versus 10%, what would you choose? Well, you're probably going to choose the 30%, right? Of course, that's cherry picking. That is just looking at the history, like very short term. Like the stock market could crash and burn by the end of this year, and this argument would fall out. But that's the whole point. If you want to make a short-term argument on GIC because you look at like a few months of returns versus the current yield, well, you have to accept the other side of the argument where you look at a few years of returns versus the GIC. Interestingly enough, if I had invested in January 2022, so before the market dropped, well, then the XIU would be up 12.47% and the SPY would be up 15.5%. So roughly, if you had like a portfolio half and half, you would be like averaging between 13 to 14%, still better than the GIC, even though you would have been starting by a correction of your portfolio double digit during 2022. Kind of crazy, right? But just to show you how it is quite volatile, and one point may seem valid for a few months, and then it's going to be completely destroyed a few months later, and so on. It could go both ways. So here's the conclusion here. Should you invest in GICs? Well, there are a good reason to invest in a GIC and there's a bad reason. So here's the bad reason, is to go back and forth when you have a focus on the yield. So every year you look at the market, you look at the yield for bonds and GICs, and then you decide where to put your money in. That creates a lot of doubt. That creates a lot of dilemmas. That is a clear lack of strategy because you just don't know where to put your money. You just look at some short-term price gain versus what recently happened. So you're going to suffer a lot from the recency bias, just thinking that what just happened may happen again, which is probably wrong in many, many cases because there are absolutely no indication that what just happened is going to repeat the next day and the next year, right? So overall, what's going to happen is you're going to suffer from paralysis by analysis. You're going to read, you're going to wonder if it's the right time to go back in the market. And then today, here's what would happen. So imagine that you invest in a GIC in 2022. Now it's about to come to maturity. And now you're thinking, damn, the market is trading at an all-time high. It's probably not the right time to invest. Well, I already told you that yesterday. It was still the right time to invest according to the literatures and all the studies that proved that even if you invest in all-time high today, it's a good thing. So if you have missed that episode, well, first you have to subscribe to the podcast, and then you have to go back to the Moose on the Loose for episode yesterday on Monday, the May 20th. So there are good reasons to invest in a GIC though. The good reason would be that it's part of your asset allocation. And when I say part of your asset allocation or part of your strategy, I mean you were invested in fixed income 5 years ago, 10 years ago, today, in 5 years, in 25 years. That's the whole point here, is you want to have a safe spot in your portfolio that you don't have to worry about, regardless if it yields 2% or if it yields 5%. So that is the key. It's part of your strategy. It's part of your asset allocation. And then you don't wonder what to do with your money. You know that you want 20% in fixed income. So whenever you have more money coming in your portfolio, you allocate 20% of your income, of your new capital into fixed income, and then you follow a clear strategy. You avoid doubts, you avoid dilemmas, you avoid wondering what's going to happen with the market or what's going to happen with interest rate. And this is how you should invest in GICs, not because they're interesting today, because what's going to happen in 3 years? Imagine that we're going back to relatively low yield, and the best you can get would be 3%. Well, then you would sell all your GICs and go back to a market that could have earned you double-digit returns for a while, but now you missed on that and now you invest? That sounds silly, right? But this is unfortunately what happens when you deal with your portfolio with no strategy and you just keep on wondering where you should put your money this year. So you have a different strategy in 21 and 22 and 23 and 35. And in the end, you may be okay, but you could have done a lot better. The other reason to invest in GICs is, of course, if you have short-term money that needs to be spent to pay off your taxes at the end of a year, for example, or if you plan on buying a rental property or your first property in the next 12 months, next 18 months, going in the market with a very short-term horizon is more looking at going to the casino. I'm not too sure it's a good idea. I mean, you do you, but I would not. I mean, I tried that once and I got burned big time when I was in my 20s, where I put my money back into the market for a few months thinking I would make a lot of money and increase my cash down for my next property. That was a huge mistake. So I'm just telling you, maybe you want to reconsider this. So all in all, GICs are not either good or evil. They're good if they're part of your strategy. It's a very bad idea to just pick them up because they offer something that sounds interesting. The 5% yield, of course, everybody wants it, but if it's yet not part of a global investment strategy, it's completely useless. All right, Moose, I hope that you have enjoyed this podcast. As usual, you know the routine. Take 2 minutes if you have not done it yet to subscribe to the podcast and give me a 5-star rating either on Spotify or on Apple Podcasts. I appreciate you for doing that. All right, we're going to talk again tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.